everyone.
I'm Fadli.
I'm Samantha.
I'm Richest.
And we are from
Group 2.
We are going to review about this Warren Buffett book, and this video is made for the final exam of corporate financial class. Please enjoy! Warren Buffett, the greatest investor of all times and the envy of investment managers and one of the richest men in the world according to the Forbes.com. He is famous of being disciplined value investors and has accumulated a great wealth of knowledge over his investment career. Millions of investors and financial enthusiasts were vying to seek the understanding of his investment principles and consistently practice in his gain benefit in the investing of endeavors. In the book called Warren Buffett Ways, the author of Robert G. Hagstrom analyzed the principles and strategies that have made Buffett the greatest investors of all time. Hagstrom traces Buffett's path for his childhood through his college years mentorship with Ben Graham to huge success of Buffett's investment partnership and through the growth and the evolution of Berkshire Hathaway. The book said that as soon as Warren Buffett was born, he was fascinated with numbers. Since he was little, when he was only 6, he went door to door selling packs of gum, soda pop, coke from his grandfather's grocery stores and sold it to anyone that passed his house. He also sold magazines and popcorns and peanuts at local football games. He finally announced he was ready to buy City Service preferred stock at only 11 years old for $120. Money he had saved from selling soda pop, peanuts, and magazines. From a young boy born in Omaha, Nebraska, 1930, graduated in Columbia Business School, be the young CEO at his own partnership company Berkshire Hathaway, until in 1933 nominated as the richest man in America with a net worth of $8.3 billion. The way Hagstrom described in the book that Buffett's 4 tenets consist of 12 principles that company must meet to qualify as potential investment and his philosophy about holding stocks through the ups and downs of stock market. These 12 principles that are classified into 4 tenets, there are 1. Business tenets, 2. Management tenets, 3. Financial tenets, and 4. Market tenets.
Based on this book, if you want to invest in a company, here what should you consider. 1. Business tenet. Do you understand the business? The business must have long consistent operating history to earn significant profit. The business long-term prospect based on how the company is managed. Here's what Buffett did. In 1969, Buffett bought his first major newspaper, the Omaha Sun. Along with the group of weekly papers, although he is respected high-quality journalism, Buffett thought of newspaper first and always as a business. He expected profit, not influence. To be the reward for a paper's owner, owning the Omaha Sun taught him the business's dynamic of newspaper. He had 4 keys of hands-on experience owning a newspaper before he bought his first share of the Washington Post company. Obviously, Buffett was aware of newspapers' rich history, and he considered Newsweek magazine a predictable business. The Washington Post company had for years been reporting the stellar performance of its broadcast division, and Buffett quickly learned the value of the company's television stations. Buffett's personal experience with the company and its own successful history led him to believe that the company was a consistent and dependable business performance. 2. Management tenet. Management tenet is talking about the rationality. Rational manager will invest excess cash in projects that produce higher rate earning than cost of capital. Investor, shareholders must get info from manager either the company makes profit or loss by the way managers communicate to the shareholders. How the manager accommodates shareholders' interest.
3. Financial tenets. Here points of financial tenets according to these books. First, focus on return on equity, not earnings per share, to judge a company's annual performance, because return on equity is the ratio of operating earnings to shareholders' equity. Second, investor must know owner earnings in a company by adding depreciation, amortization charge to net income and subtract the capital expenditure. Third point, high profit margins reflect not only a strong business, but management's tenacious spirit for controlling costs. Buffett loves managers who are cost-conscious and abhors managers who allows costs to escalate. Indirectly, shareholders own the profits of the business. Every dollar that is spent unwisely deprives the owners of the business a dollar of profit. Over the year, Buffett has observed that companies with high cost of operation typically find ways to sustain or add to their costs, whereas companies with below average costs pride themselves on finding ways to cut expenses. The company must create at least $1 for every dollar retained from company's net income, subtract all shareholders' dividends to know company's retained earnings, then add the company's retained earnings over 10-year period. After this, you can determine the difference between the company's current market value and its market value 10 years ago. If increase in the company's market value is less than the sum of the retained earnings, the company is going backward.
4. Market tenets. Value of businesses. Business value is expected cash flow of a company discounted by appropriate interest rate. Cash flow is owner's earning by measuring owner's earning over a long period. You will understand whether they are consistently grow at same average rate or merely bubbling around constant value. If the earning is bubbling around, you must discount it with long-term interest rate. Better use conservative estimate rather than being enthusiastic to inflate business value. Buffett used long-term US Treasury rate is discounted factor. He will adjust discount rate upward when interest rate declines. Second, calculate owner earning and invest in companies with positive and growing earning. Owner's earning equal net income plus depreciation and amortization, less capex, less additional working capital. Working capital equal current asset less current liability. If result is positive, means additional working capital, but if negative, it means decrease in working capital. A positive owner earnings means that the company generates cash in excess of its need. After knowing business value, you must know can business be purchased at a significant discount to its value. Business value is not mathematically complex, but wrong future cash flow estimation can be problem. Buffett deals with this by correcting future cash flow prediction by sticking with businesses that are simple and stable. He also insists there must be margin of safety between the company's purchasing price and determined value. Portfolio management. Warren Buffett gives suggestion for average investor to buy stock from 5 to 10 companies. Legitimate investor is suggested to buy 10 to 20 company stock. He suggested us to buy stock of a few companies but perform well rather than buying more companies stock but perform poorly. Horse racetrack from Charlie Munger is a perfect illustration for investor. Good horse in a race pay 3 to 2 while bad horse pays 100 to 1. But statistically, it's not clear which is the best bet. The good or bad horse, too often investors are attracted to a long shot that pays incredible odds, but for any reason they never finish race. Sometimes they pick the sure things without ever considering payoff. We must have long-term goals. For example, being happy when price goes up, and when price goes down, we assume there is a bad thing. This is a poor mental habit. Investors shouldn't be overconfident. Investors are highly confident they are smarter than anyone else because they have tendency to overestimate their skill and knowledge. They also typically rely on information that confirm their belief and disregard contrary information. Too often, investors and money managers are endowed with a belief that they have better information, therefore can profit by outsmarting other investors. Overconfidence explains why so my money manager makes wrong calls. They take too much confidence from the information they gather and think they are more right than they actually are. If all the players think their information is correct and they know something that others don't, the result is great deal of trading. Investor who wants to buy stock must have future orientation. It's risky if investor to buy stock today to sell it tomorrow. But if the stock is for being owned in a long time, it will be less risky. Let's say 10 years. Diversified portfolio is good to anticipate volatility of stock price. So, if one of stock price goes down, we might have other stock with better price.
Investors should be patient with progress in the company where they buy stock. Coca-Cola, for example, in 1989 until 1998, Coca-Cola did outperform. What did Buffett do for overcoming that? Instead of selling his stocks in Coca-Cola, he first checked the economic progress of Coca-Cola, and it still was excellent, so he still owned Coca-Cola. Intelligence is not enough for investor, because investor needs to master the emotion through patience when the stock was in a company that was not in good condition.
Now, who said that education is not important? Well, maybe for a mediocre business it is. But if you want to be a success as Warren Buffett, look at his background. Education is the most important thing to reach the top of financial ladder of the society. Even Buffett, who has stunningly powerful intellectual, he must rely on the teaching of those who came before him. For not even he skipped of the learning process of his trade history. Warren Buffett shaped his mind, skill, and intuition from those minds of three powerful figures. The first one is Benjamin Graham, the economist, professor, and investor that is widely known as the father of value investing. Found research in securities laid the groundwork of in-depth fundamental valuation used in stock analysis today by all marketers. The second person is Philip Fisher, the author of Common Stocks and Uncommon Profits, a guide to investing that has remained in print since it was first published in 1958, and Charlie Munger, a former real estate attorney and vice chairman of Berkshire Hathaway, that was instrumental Berkshire in the growth of the company into a giant holding company with market capitalization of $700 billion. So, for those who like to skip schools, this path is not for you, kids. Management is rational. Management is honest with shareholders. Focus on return on equity, not earning per share. Invest in business with positive and growing owner earnings. Invest in business with high profit margins and know the value of the business. So, in the end of this discussion, if we want to be the successful investor, think like Warren Buffett. First, remember the Buffett's tenets. Train your emotional intelligence. Don't get overjoyed when things appreciate or downcast when they don't. Focus on the long-term competitive advantage. Persistence and continuous learning. And if the company does not pass your turned skin, do not purchase it. Be patient and wait for the right business. Okay, so that's all from us.
Thank you for watching.
Please like, share, comment, and subscribe.
Happy investing!